In this episode, we delve into the intricacies of the UAE corporate tax, a significant development in the nation's economic landscape.
Indeed, Sophia. We'll be unpacking the key features of this new tax law and exploring its impact on various stakeholders, including investors, regulators, and the public. This is crucial information for anyone involved in or interested in the UAE business environment.
The UAE corporate tax, officially known as Federal Decree Law No. 47 of 2022, represents a substantial shift in the UAE's taxation framework. It's important to understand its core components.
Absolutely. The law introduces a 9% tax rate on taxable income exceeding a specific threshold. Interestingly, there's a 0% rate for taxable income up to that threshold, offering some relief for businesses. Furthermore, qualifying free zone persons enjoy a 0% rate on qualifying income and a 9% rate on other taxable income, acknowledging the unique role of these zones in the UAE economy.
That's a nuanced approach to taxation, catering to different segments of the business community. Now let's delve deeper into how this tax impacts various stakeholders. Starting with investors, the corporate tax introduces a new factor in investment decisions.
Precisely. Investors will need to carefully assess the tax implications of their investments in the UAE. Modeling potential returns will now require incorporating the 9% tax, potentially affecting the overall attractiveness of certain investment opportunities. However, the 0% rate on the initial portion of taxable income and the special provisions for free zones might mitigate some of these concerns.
For regulators, this new tax regime presents both opportunities and challenges. It provides a new revenue stream for the government, but also requires careful administration and enforcement.
Absolutely. The Federal Tax Authority will play a crucial role in ensuring compliance and managing the complexities of the corporate tax. This includes tasks like tax registration, return filing, audits, and handling potential disputes. A robust and efficient regulatory framework is essential for the success of this new tax regime.
And what about the general public, Lily? How will the corporate tax affect them?
While the tax is levied on businesses, the general public could be indirectly affected. For example, businesses might adjust their pricing strategies to account for the tax, potentially impacting consumer prices. On the other hand, the increased government revenue could lead to more public spending, benefiting citizens in various ways.
That's a crucial point, Lily. The ripple effects of this tax can extend beyond the business world. Let's now shift our focus to compliance. The decree law outlines specific procedures for tax registration, filing returns, and maintaining records.
Yes, Sophia. Compliance is paramount. Businesses will need to familiarize themselves with these procedures and ensure they meet all requirements. Failure to comply could result in penalties and fines, as outlined in the tax procedures law.
Speaking of penalties, the law provides for various penalties for non-compliance, ranging from fines to more severe consequences.
Indeed. These penalties underscore the seriousness of complying with the corporate tax regulations. Businesses should prioritize understanding and adhering to the law to avoid potential repercussions.
Now let's explore how the corporate tax interacts with other laws in the UAE. The decree law makes references to several existing laws, including the tax procedures law, the value-added tax law, and laws relating to free zones.
That's right, Sophia. Understanding these interrelationships is vital. For instance, the tax procedures law outlines general procedures for tax administration, which are also relevant to the corporate tax. Similarly, the free zone laws need to be considered alongside the corporate tax to understand the specific tax implications for free zone persons.
And what about the relationship with international agreements, Lily?
The decree law acknowledges the primacy of international agreements. If the terms of an international agreement conflict with the corporate tax law, the international agreement will prevail. This is crucial for businesses operating across borders and subject to multiple tax jurisdictions.
All these details can seem a bit overwhelming. It's like trying to assemble flat-pack furniture without the instructions. You might end up with a wobbly table and a few extra screws.
I see your point, Sophia. But fear not. Resources are available to help businesses navigate these complexities. The Federal Tax Authority is expected to issue guidance and clarifications to help businesses understand and comply with the law.
Absolutely. Now let's recap the key takeaways. The UAE corporate tax introduces a 9% rate on taxable income above a certain threshold, with specific provisions for free zones. It impacts investors, regulators, and the public, and requires careful compliance with detailed procedures.
And don't forget the importance of understanding the relationship between the corporate tax and other UAE laws, as well as the primacy of international agreements.
It's a complex landscape, but one that businesses need to navigate effectively. Just remember, Lily, even a complex tax law can't stop us from making bad puns. It's taxing, but we're up to the challenge.
I suppose we are, Sophia. And on that note, we conclude our discussion on the UAE corporate tax. We hope this episode has shed light on this important topic. Remember to stay informed and seek professional advice if needed.
Have you tired the new Tax Dosti website? No? Then visit today at taxdosti.com. Yes, taxdosti.com. Have a great day.